When I make a sale of a product or service from the regular operations of my business, this is called either sales or revenue. And this is typically a credit. When I'm running my business, I am going to create credit in my revenue accounts, which results in income, which would go onto my income statement. The income statement also includes expenses, and again, these are accounts pulled out of the general ledger that reflect expenses by the business, regular expenses by operating a business. I have two basic types of expenses. I have direct expenses. These are the expenses that are related to generating the product or service. So direct labor, direct material, or direct overhead in creating a product or creating the services that I'm selling are my direct expenses. Indirect expenses are the expenses that may occur every single month. So they're not related to the creation of the product or providing the service, but they're regular expenses that incur every month, such as advertising, rent, utilities. These are not related to the production of the revenue, but incur from running a business. The net income less direct expenses is called gross profit. Income less direct expenses, or my sales or my product or service less direct expenses, is referred to as gross profit. It's very important to understand gross profit because I can compare my gross profit on a monthly and annual basis and understand if it's going up or going down as my revenue increases. Then I have general and administrative expenses that come after the gross profit on my income statement. I know you're wondering, what exactly does this look like? So here I have an example of an income statement that has just straight revenue or sales less expenses. And so the sales come first, expenses next, to arrive at my net income. And the net income is included in equity as retained earnings. And again, this is what helps the balance sheet balance. As a business operator, manager, owner, it is important to understand the income statement. And many business owners do not. I once had a business owner tell me he thought he was making money and his bookkeeper told him that he was making a profit until his CPA prepared his financial statements and had a number at the bottom of the income statement in brackets. When he asked, "What do those brackets mean?" the CPA said, "That shows that you are losing money, and you are losing a lot of money." I was very fortunate for that business owner that he'd been in business for a number of years and had a healthy reserve, so it did not put him out of business. But honestly, business owners can operate at a loss, not realize it, and before you know it, they run out of reserves and have to go out of business. So important for you to understand your income statement and know if you're making a profit or not. I also had another business owner that was making very little, if any, gross profit on every dollar of revenue that she was making and wondering why she was having such a struggle running a business. You need to have a healthy gross profit to cover your general and administrative expenses. If you're increasing your revenue just to get very little gross profit, you're probably losing money. When I create an income statement, there might be a business where it's fairly simplistic, where my revenue's less expensive, create my net income. That's all I need on my income statement. But frequently businesses are more complicated than that, where revenue's less cost of goods sold. In other words, the direct expenses related to the revenue equals gross profit. That's an important thing to track when you're running a business and actually helped me when I was running a large business because my revenue was going up and my gross profit was going down. Fortunately, because I tracked gross profit on a monthly basis, I caught this fairly early and I was able to fix it and not lose money while running this business. but many times business owners do not recognize the importance of having a good, strong gross profit. I had a client who wanted to keep increasing revenue at the expense of low gross profit. And at some point, a business has to cover the general administrative expenses with gross profit. So if the gross profit is too low, it doesn't matter how much you increase revenues, you're going to go out of business. This is an example of how to reflect cost of goods sold. If I have direct labor, I'm going to debit direct labor, credit cash or credit accounts payable or credit accrued salaries. For direct material, I'm going to debit direct material. These are both cost of goods sold accounts. And when I'm recording these, you will be able to see how this affects my income statement. First, I'll show you what the balance sheet looks like. Because I had those two activities, those two journal entries, I reduced my cash to $600. And because I had the additional expenses, that reduces my retained earnings and my equity. And so my equity is less. My total liabilities and equity are less. Notice my assets still equal my total liabilities and equity. And this is great. You get to see an income statement that reflects my new item in here, cost of goods sold. So my cost of goods sold, these are expenses directly related to generating sales. My sales less cost of goods sold equals my gross profit. This is where it sits in the income statement. That gross profit number, that's what I want you to pay attention to. That's what I want you to track. And I want you to track it as a percent of revenue. You're going to track gross profit as a percent of revenue. And that's an important number to running your business effectively. Then below the gross profit, I have my general and administrative expenses, salaries, utilities, rent, total expenses. Then I have the net income. As I said before, my general and administrative expenses are expenses that are really relatable to the period and not to creating the revenue. So you saw the examples are salaries, utilities, and rent. And they are just the regular cost of doing business. They are not a cost of generating the revenue directly, but they are the cost of doing business. And after my general and administrative expenses, I have my revenue, my cost of goods sold takes me down to my gross profit, less the general and administrative expenses, and all of those things are culminated to result in my net income. This is great. I know you know the answer to this one. The gross profit is A, the income less general administrative expenses, B, the revenue less the cost of goods sold, C, the net income less the general and administrative expenses, or D, the assets less the equity. You are brilliant because you got this right. The answer is gross profit is B, the revenue less the cost of goods sold. Good job. You've had a chance to see how a balance sheet and income statement are put together. Now you need to understand how important it is to review your financial statements on a monthly basis. You need to know if you're profitable or not, and certainly if you are not profitable, fix whatever is going on so you can be profitable, and watch your cash balance. That is such a critical component of your financial statements, your cash balance, because if your cash is dwindling on a regular basis, you need to rectify that situation so that you don't run out of cash. Know where your balances are going. You need to make sure that you review your balance sheet and income statement on a monthly basis and use these financial statements to run your business properly.